talk about some of the politics and policy driving this gold wave. It's all over the world right now. We have CNBC contributor and former Labor Secretary Robert Reich, who's the author of Super Capitalism, and we have New Hampshire Republican Senator Judd Gregg. First of all, welcome to both of you. Mr. Gregg, as always, you have been ahead of the curve on this story. I mean, I'm reading a moneynews.com, sort of a reprint of something you said a while back, that the U.S. may follow Greece into a debt crisis. And Senator Gregg, when you look at this gold explosion, it seems so closely tied to the explosion of spending and deficits and debt and the potential for defaults and governmental bankruptcies, including our own, sir. And I just want to get your take. Does Washington see the gold message that is going on in Wall Street and the financial capitals around the world?
Unfortunately, no. But if you look at what's happening, it clearly is a track which is very dangerous and extremely unsustainable. Almost all the Western democracies have a very serious problem, which is that they are highly over-leveraged, and that's only part of the problem. The second part of the problem is that they have an aging population, an aging demographic, which is going to add dramatically to the costs of government in the out years. So in most instances where countries get over-levered, you can say, well, they are going to be able to grow out of it and they'll get their economies back together. That's certainly been the American experience. But as you look down the road, it's very hard to grow out of a doubling of your retired population when you have a huge commitment to that population in the area of services and costs. So you see the American debt being projected at doubling in 5 years and tripling in 10 years, going to 100% of GDP, public debt going to 100% of GDP, which essentially puts you in the same status as Greece or junk bond status or a banana republic, unfortunately.
Bob Reich, come to you because, look, Robert, you and I are old friends, but a lot of people blame this gold rally on the explosion of Keynesian government spending stimulus, allegedly to promote aggregate demand during the recession. Now we are at a tipping point, that's the message of gold, which says we are paying for we are buying all these services and spending all this money, but we cannot afford it. And you know, Bob, my old friend Margaret Thatcher used to always say, the trouble with socialist governments is they ultimately run out of other people's money, Robert Reich. Do you have a response to this? Do you feel that following your policies has caused this gold boom?
Larry, beyond your rhetorical question, let me just respond to Senator Gregg and agree with him that in the out years, 10 years from now, 12 years from now, 15 years from now, there certainly is a budget issue, a budget problem. Some of the big entitlement programs, particularly Medicare, do have to be brought under control. In the United States and in other countries, you're seeing an aging of the population that is going to make huge demands fiscally unless some controls are put on and unless we understand how to bring that spending down and also raise revenues appropriately. In the short term, though, Larry, I've got to disagree with you. And that is in the short term, unless government does spend, because the private sector, both governments and also, companies and also private individuals are deleveraging like mad. Government is the spender of last resort. Government does have to spend in the short term in order to get economic growth back.
Well, all right. I know that's your view, and I'm more optimistic in the short run. I don't think this government spending has really affected the economy at all in any major way. But, Senator Gregg, taking my friend Bob Reich's point, I'm interpreting this gold bulge. I mean, this thing is just happening on a daily basis. You know this, up to $1,240, whatever. The gold signal is saying to governments in Europe and the USA and elsewhere, we can't wait 4, 5, or 6 years, that we have got to start now. I mean, there's an urgency to this gold move, and I don't see that sort of urgency down in Washington.
I think the urgency is driven by the fact that there's no safe currency right now in the view of most long-term investors, unless you want to go to China or to Norway or to, which doesn't have a currency, but you can buy their debt, or to Australia, which doesn't have a very big economy. The problem is that most investors have a long-term view, and they want to make sure that when they invest, they're not going to have their investment devalued by inflation. But if you look at the projections on all the Western European democracies, the United States and Japan is much worse than we all are, there is a very serious systemic problem. Structurally, you cannot meet your demands as a government in the out years without either inflating your currency or massively increasing your taxes and thus reducing your productivity as an economy. So people are very worried about where to put their dollars or their whatever they're holding their assets in that's secure, and so they look at gold as the one consistent value. My own view is, however, that the United States will correct. We are a vibrant and resilient economy, and we are basically entrepreneurial at our core. We will correct, and people who are investing in gold today will make money in the short run, but I suspect they may find themselves in a speculative bubble here in 2 or 3 years if we've taken the type of actions we should take as a nation to get our out-year debt in line.
Well, listen, I'm usually the optimistic guy, but I got to tell you, I'm getting pretty worried. And Bob Rice has another point here. I mean, look, if you're overspending like this and creating all this debt, what are your options? You can default on the debt, which is part of the European Greek crisis. You can jack up taxes, which, as Senator Gregg said, is going to depress growth and productivity and ultimately worker real wages. Or, Robert, on top of those two, you can inflate. And a lot of people think that with La Tarp coming out of Europe, the European Central Bank is about to launch a massive inflation of their money supply as a way out of this. Hence, gold explodes up, Bob. That's why I think there's an urgency to this.
Larry, there is absolutely no sign of inflation, certainly no sign of inflation in the United States at all. The big worry around the United States and in other places is deflation, or at least the worry that we're not going to really get out of the recession bog that we are really in right now. You know, I think that what you are losing sight of, Larry, and this is a very important point, is that we do have to have enough demand to get us out of the problems we really now have. Inflation is nowhere near in sight. Investors are fleeing to gold. Why? Because of the instability, because they don't know what's happening in Europe. They're a little bit worried about what happened last week in the United States with regard to that huge drop in the stock market suddenly. There's enough instability around the world to drive investors towards safety, but it's not being driven by inflation.
But how many times in the past history have we seen that when currency confidence plunges and gold rises, it is a harbinger? It is a foreshadowing. It is a portent of future inflation, Robert. That's my point.
That's the only option here, Larry. As a very practical matter, if the reason people are buying gold is because they don't think people can pay these debts off, these sovereign debts off, and they recognize that to pay them off, you're just going to have an inflated event, or alternatively, you're going to have a market event which involves massive tax increases, which reduces productivity, which inevitably undermines the value of the currency also, in my opinion. So the real issue here, I think you got to divide the pie, though. Europe has a very serious problem because as they do this stimulus, which Professor Reich is talking about, which is going to supposedly generate growth, and by the way, governments cannot grow you into prosperity, in my opinion, but as they try to create economic activity by expanding their expending and pumping a lot of money in the way the Fed did, the ECB doing this, they don't have the economic growth engine over there to pick that up. We in the United States, on the other hand, can probably pick up what the Fed did fairly reasonably in the context of our usual growth patterns and our resilience as an economy. Europe doesn't have that any longer. They're going into, I think, a period like Japan because basically they do not have the dynamic economy which allows them to grow their way out of the short-term stimulus which they're going to put into the economy, and that's going to create inflation.
Let me take a short break.
Look, we're mixing apples and oranges a little bit. Let me just say right now.
Hold those great, brilliant thoughts. Hold those great, brilliant thoughts. I know they're coming. I expect no less. I've got to take a commercial break, and then you two will come back. I want to get the Rice thoughts on the table. I want to talk about what kind of solutions here in the U.S. There is a fiscal deficit commission of which Mr. Gregg is a member, if I'm not mistaken. I think the gold market is signaling, take a look at me. I'm in revolt, all you governments. You have to do something now. That's the way I see it. There is urgency. But let us move on. Please stay right where you are, gentlemen. Gold is surging big time. It's up to about $1,240. Another big gain this week. We are talking about the breakdown of fiscal policy in Europe, in the United States, in Japan, all around the world, and the fact that central banks seem to be priming the pump by printing huge amounts of money to finance these budget deficits, which may or may not bankrupt the countries, but inflation is a form of economic bankruptcy. We are talking this evening with Robert Reich and Senator Judd Gregg. Robert Reich, you had a great thought, a brilliant thought, no doubt, at the end of the last segment, and I wanted to give you ample opportunity to ventilate this thought, whatever it may be.
Well, I shall ventilate very, very briefly, Larry. The point is that a run on Greece, or like a run on the banks, is very, very different from something that spurs inflation or kind of a systemic problem that a government or a set of governments have. I mean, Greece is a unique case. Greece's debt is about 113% of its entire national economy. This is not sustainable. But as the senator knows, because if my memory serves me correct, Senator, 20 months ago you were a major supporter of the bailout of Wall Street. You've got to, in order to prevent runs on countries or on banks, sometimes you've got to provide enormous shots of liquidity.
Well, that's correct, and we did that under TARP, and we did it correctly, in my opinion. I don't think the stimulus package that followed was correctly done, however. I would note, however, I think the issue here is the structural underlying problems of all these governments in varying degrees, and the United States is not that far behind. The big advantage we have is we have much more resilience in our economy. We have much more elasticity in our economy, and we do have the capacity to basically monetize our debt if we have to, which hopefully we wouldn't do. But as a very practical matter, when our debt to GDP ratio, public debt to GDP ratio crosses 60% this year, we're on the wrong path. And when it hits 100% 7 years from now or 8 years from now, we're basically on junk bond status.
Well, listen, Senator, on this point, okay, we have we're moving towards the Greece GDP to debt levels and so forth. But, you know, David Leonhardt, a good reporter, good analyst for the New York Times, he's got a big front page story. Is this a Greece moment for the U.S.? But the one thing I didn't agree with him on is that the U.S. people want this. I mean, poll after poll seems to show that the majority of voters want smaller government, fewer services, and don't want their taxes raised at this point. And this is where the gold theme plays in. It's like gold is cross-roughing to the voters, and what we're waiting for is a triangulation coming out of Washington to deal with these protests. When's that going to happen? You're on the Deficit Commission, sir.
Cross-roughing, triangulation, those are too many technical terms for me. I'll tell you what we got to do. We got to slow down the spending. We actually have to stop the spending. I mean, that's what it is. This is not a revenue issue as a nation. We've taken spending growth in this country from 20% of GDP up to 26% of GDP. It is projected that next year and the year after, revenues will go to 20% of GDP. That's 2%, almost 2% above the historic norm, but we still can't close that gap. Why? Because we've exploded the size of government. And basically, that's a function of two things. This administration generally believes that you create prosperity by growing government, and we have this retiring baby boom generation, which is going to double the number of retirees and their benefit structure. So we've got to step up and basically adjust our entitlement structure in this country, or we will not get our house in order, and that means controlling spending.
See, Bob
Senator,
Rice.
with due respect, may I just ask? I mean, when the health care bill was enacted, Senator, I believe you, certainly a lot of Republicans said, you are going to wreck Medicare. You're going to put tremendous burdens on the elderly. If you're not going to control the growth of Medicare and you're not going to control Social Security, where are you going to make your spending cuts? I mean, those and national defense and national security, those are the big pools of money.
You're absolutely right, Professor. Bob went to Dartmouth, so I give him great deference. The issue is Medicare, and the issue is Social Security. The problem with the health bill, and this is what I said and a lot of Republicans said, was that when we reduced spending in the health care bill, which many of us would have supported if it had gone to actually addressing the fundamental issue of making Medicare more solvent. What happened, though, was they took the $1 trillion of savings in Medicare, which are spending reductions, basically, and moved them over and created a new entitlement. Well, you can't do that. What you had to do with that $1 trillion was actually use it to make Medicare more solvent. Do we have to address Social Security? Absolutely. That's what I hope this financial commission, I think if there's one bright light in this financial commission that the president's put together, it is the fact that we may get a Social Security proposal out of it that would be very constructive in that area.
See, Robert Rice, the gold signal, I know you don't like it, but the gold signal has been flashing this really all during this health care debate. As new entitlements were added, gold continued to rise. Gold really started rising in earnest really about a year ago during the stimulus package debate. And now gold is taking off again as the European Union is doing this TARP, what I call La TARP, which looks a lot like what we did, which looks a lot like more spending and borrowing. And yeah, they're loan guarantees, and their central bank, just like the Fed, is going to start pumping dollars out. I mean, Robert, the gold saying stop. The gold thing is saying stop, but you're saying we don't stop. We shouldn't stop. There's a disconnect
Larry,
there.
Quite the contrary. I am in full agreement with Senator Gregg that in the out years, with regard to some of the biggest entitlements like Medicare, something has got to be done. What I don't understand is what Senator Gregg is proposing. For example, and let me give you a very concrete example, why not allow Medicare to negotiate with drug companies lower prices? Now, this is something that Republicans and certainly many Democrats said absolutely no, we don't want Medicare to negotiate lower drug prices, but why not use their bargaining leverage? This is one way of controlling the increase in costs.
Well, CBO scored that as zero savings, Bob. That's the basic reason we didn't do it. I'm willing to look at anything, however. You know, if you can come up with a score that says that's going to save us a lot of money, I'll be willing to look at that. But
gentlemen, gold is saying we don't want all this. Gold is saying no matter how you do it,
we have to control the amount of spending that we're doing on our retired population. When your retired population is doubling and you don't have the capacity to support it.
That's the message of gold, and it's also saying, by the way, if you continue down this path, then the central banks are going to print more money than you can shake a fist at, and the currencies become worthless. That's what the message of gold is. All right, gentlemen, I got to get out. You're both very kind. I appreciate the discussion. Bob Rice out there at Berkeley, California. Senator Judd Gregg in Washington.